Hello, friends. Hope you're doing well. Chris Lee, CPA here, back for another video. And today we're going to talk about tax year 2025 year-end retirement planning deductions. So, as the 2025 year comes to a close, that means retirement comes, just another year closer. And so we want to think about the available opportunities as we come to the year end. So we're going to talk through 5 basic strategies that you could consider, and some of these are items that we're talking specifically with clients about. So the first thing is, if you don't already have one, go ahead and establish your retirement plan for 2025. So oftentimes with solo owners, we're going to think about implementing a solo 401k plan. That is the most tax advantaged account you can open as a solo owner. And this would be in the case of, an S corporation or a sole proprietorship. And the huge benefit that comes with the solo 401k is that we get 2 available levels of contribution. One is the employee deferral, or in the case of the sole proprietor, the proprietor's deferral. And those are just the typical statutory limits that you'll see of, if you're under 50, $23,500 for 2025. If you're, ages 50 to 59 or over 64, it's $31,000 cap annually. And if you're between ages 60 and 63, it's going to be $34,750. Now, those are your deferrals, right? Like, rather than what you take home from the business, you go ahead and divert it to those accounts, and it becomes non-taxable currently. And then when you come out of retirement, what you'll see is that those amounts will be taxable. Now, this is the real kicker that is super beneficial. We get the employer contribution component. So the employer contribution component in a solo 401k is up to 25% of compensation, paid during the year. So that up to certain thresholds. So that is a huge benefit. And this is on top of the $23,500 you could defer. So what happens here is the employer contributes to the solo 401k account. It becomes a deduction as an employee benefit on the tax return, and it sets into a tax-deferred account. And so it's non-taxable currently, but when you take those out in retirement, they become taxable. Now, the employer component, like I said, is up to 25% of compensation, subject to overall limitations. So if you're under the age of 50, the max amount between the employee deferral and the employer contribution is $70,000. So the two combined, if you're between ages 50 and 59 or over 64, that max amount is $77,500. And if you're between ages 60 and 63, the max contribution is $81,250. So huge benefits there. If you're going to go with setting up a retirement plan, the solo 401k is the biggest opportunity you have for deferrals. Solo 401ks can be the most expensive and most difficult to administer, but honestly, there are so many out-of-the-box solutions now that it's pretty easy to manage that effectively, and so it's not as cumbersome as it used to be. So second planning opportunity, we can think about claiming the retirement plan startup tax credit. So if you're not a solo owner, but you do have employees and you don't have an existing plan, you can start, generating tax credits by implementing a retirement plan. So this can be implementing, a SEP IRA plan, a simple IRA plan, or a 401k plan, any kind of defined contribution plan, or even a pension plan. Sometimes those are referred to as a defined benefit plan or a cash balance plan. All of those kind of mean pension plan, which is to say this is how much you get in retirement. Regardless of what you're setting up, if you're setting up a new plan, you can generate a tax credit for those costs to start that up. So It's the greater of $500 or $250 for each non-highly compensated eligible participant, up to $5,000 a year. So if you have 50 or fewer employees, the credit covers 100% of qualified startup costs. Employers with 51 to 100 employees receives a credit for 50% of the costs. That credit is available for 3 years. And so the max available credit is $15,000. So qualified expenses here are going to include plan setup, administration, and employee retirement education. So one thing to note when you're thinking about this, solo owners do not count for this credit because they are treated as highly compensated employees. So the general theme when you're talking about retirement plans is being concerned of who is treated as a highly compensated employee versus who is not. And highly compensated actually sometimes takes a qualitative role rather than a quantitative role in that consideration. So if you're the solo owner, by definition, you're going to be treated as highly compensated regardless of the amount. Oftentimes, like the threshold somewhere around $150,000 of like what is highly compensated. But because of the discretionary element that is in a solo owner of what they actually pay themselves, oftentimes, that solo owner is going to be treated as highly compensated regardless of what figure actually flows onto the W-2. So if you are going to, if you joined, if you had multiple, if there's like a multi-employer plan, like you've got multiple businesses and one plan that covers them, if you joined after 2019 and missed the credit, you may be able to retroactively amend returns for that opportunity, but that is kind of a facts and circumstances item that needs to be considered. So first, we talked about establish a retirement account or retirement plan. 2 was claim the retirement plan startup tax credit. Number 3, claim this new small employer pension contribution credit. So this is up to $3,500 per employee. So beginning in 2023, another tax credit was added for employer contributions thanks to the Secure 2.0 Act. And this is up to $1,000 per employee for employer contributions in the first year. So the first year contributions, up to $1,000 of employer portion contributions can come right back as a tax credit. This is then phased down for years 1 through 5, 100%, 75%, 50%, and 25%. And in year 6, it's a 0% tax credit. So employers with 51 to 100 employees, they reduce the credit by 2% for each employee. So the larger the employer, the smaller the credit. Employers with over 100 employees aren't eligible for the credit. So the credit does not apply to contributions to the defined benefit plans I mentioned earlier. So that is, a cash balance plan or amounts that are contributed to any other form of defined benefit plan. That is to say, how much, rather than the employer contributes a specific amount, a defined benefit plan is a retirement plan that says this is how much benefit you get in retirement. It's not dependent on what the employer puts in. It's dependent on the employee getting a specific amount. So employees earning over $105,000 in 2025 do not qualify for the credit. Next, item number 4, claim the automatic enrollment credit. So there was a new credit introduced a few years ago under Secure 2.0 Act that included a $500,000 annual credit for 3 years when an eligible small employer adds an automatic enrollment feature to their 401k or simple IRA plan. So beginning in 2025, most new 401k and 403b plans must include an automatic enrollment feature. And so for that reason, like this is actually a credit that should be asked about for pretty much every client that does have a retirement plan because of those automatic enrollment requirements, which came out of the Secure 2.0 Act. So fundamentally, the government says you must do this, and here's a credit for it. You don't need to spend anything to receive the credit. This is just for the fact that like you have that feature turned on for your employees, and so by having that feature turned on, then you're eligible for the credit. So solo owners again do not qualify because they only have a highly compensated employee on their books, and so they're ineligible. So basically, whenever you're talking retirement items, if it's solo owner, you basically are not going to be eligible for any of the tax credits. Next is with regards to traditional IRA accounts. That means they went in with a current tax deduction or pre-tax. That's what you'll also hear. So when you hear pre-tax and you hear traditional IRA or traditional 401k, pre-tax 401k, all of those mean the same thing. It means you got a benefit in the year that you put the money into the account. One thing to consider is, number 5, converting your traditional retirement account to a Roth account to produce the tax benefits in retirement. So this allows a Roth account is to say that, oh, these funds have been paid tax on, and the government, they're in a tax advantage account, and rather than taking them out in the future and getting taxed on them, then we'll choose to take the tax, pay the tax now, and let the funds grow tax-free. So this is a long-term tax planning strategy. It's not a current year tax planning strategy. So this is a strategy we'll use if your account value is down or you expect higher tax rates later. So this is to say, like, if you're going to have a low income tax bracket in the current year and maybe your account balance is down, you could actually pay tax at a lower rate now and then have those funds compound well into the future and take them out tax-free. So this is, and then sometimes people will choose to do this just in order to have kind of what we refer to as the tax triangle built out. So when we think of the tax triangle, when it comes to retirement funds, we'll say we want Roth funds, we want pre-tax funds, and then we want traditional brokerage account funds, so after-tax funds. So the 3 together give us a lot of opportunities in retirement to pull levers and make sure that we're minimizing tax along the way. So conversions pay off because they lower the conversion cost and current value if current values are currently down in your account. Contributions to a Roth account can be withdrawn anytime, tax-free and penalty-free. So that's the contribution, like the actual dollars you put in are able to be withdrawn anytime, tax and penalty-free. Converted amounts may be able to be withdrawn tax-free after, subject to a 5-year penalty window. So after 5 years, you could pull them back out. Roth earnings are tax-free after 59.5 and a 5-year holding period. And then there's no required minimum distributions on Roth IRAs. So what an Roth IRA conversion is basically say, okay, we've got pre-tax dollars sitting in an IRA account. We want to move them to a Roth account. Well, that's a taxable event. So basically we take a one-time hit and include that income on our tax return, pay the tax on it, and then now they're treated as Roth dollars. So that's what a Roth conversion is we trigger that quote, we simulate a distribution from the IRA early. It's just not subject to penalties because it's a penalty accepted quote unquote distribution, because it's going from one tax advantage account to another. It's just a taxable event on the conversion. So if you the reason that keeping funds in a traditional account can be kind of disadvantaged is because early withdrawals trigger tax, and a 10% penalty. Withdrawals are fully taxable. They're subject to required minimum distributions when you retire, and that could be at age 73 or age 75. And then the heirs pay tax on, so if you pass and you bequest the assets to loved ones, they will pay tax on the assets as they're withdrawn. That does not occur on Roth IRA accounts. There's no tax on the withdrawals. So the most important thing, or like a very important thing, is to always pay the conversion tax from outside funds. So funds at your bank account, funds at a brokerage account, not from the IRA itself, because if you take funds from the IRA to pay the tax, that's treated as a non-qualified distribution and gonna, have tax and penalties subject to it. So if your business is going to generate a loss this year, and or you've got a lower account, you're kind of like in a down year in your account, a Roth conversion may be helpful. I will say in the past, I just wanted to have more Roth assets, and I chose, even tax it inefficiently, to convert my account for the purpose of, to build out my tax triangle more effectively. And so with a long-term tax strategy in play. So those are the 5 things we want to think through as far as, you know, year-end retirement account planning. So one is, if you're a business owner and you don't already have one, establish a retirement account, a retirement plan. Solo 401k is the best in my opinion, but it also can be the least cost effective, but in the end you get the most amount of benefit, I believe. Second is consider the 2, 3, and 4 items. 2 through 4 are available, considering the available tax credits. So there's the startup tax credit, the employer contribution credit, or the automatic enrollment credit. All of those have, you know, their features and requirements. So be sure to connect with a tax professional if you think those apply to you. And then lastly, consider a Roth conversion strategy to create, you know, long-term tax-free growth on those assets. Just make sure you cover the tax costs from those from that conversion transaction from a non-retirement fund account. So with that, I'll leave you all to it. Feel free to connect using the link in the you know, in the description, and otherwise I will have a new video for you soon. So take care. Bye.